people live in homes, not corporations. That is a direct quote from President Trump. He's going after Wall Street and the institutional home buyers. What does this mean? What happens next? What could go wrong? What could go right? You know what? We've got the one and only Lance Lambert from Resi Club, who, if you weren't paying attention, said in a tweet at the end of 2025 that a lot of big things were coming to the real estate market. And now he is saying this is just step one. So there are more things to come. Lance, what's going on, man? It's big news.
Yeah, so the Trump administration, they're going to roll out a lot of different policies on the housing front in January. And a lot of that, of course, is one, some of the other priorities that kind of dominated 2025 on the tax front and the tariff front, and some of the stuff on the housing front, including Fannie and Freddie Mac, that was always the next step, right? And then the other thing is, we're going into a midterm year, right? There's a midterm election. And if you looked at what happened back in November, you had Mandani, who won in New York. His whole campaign, he ran on affordability. Yes, all of his background and, his views, democratic socialism and all that stuff, that, but his core message was affordability.
Correct.
And I think Trump realizes that affordability is a big pain point right now. And a lot of that makes sense. When you go through an affordability, or you go through an inflationary shock, like we did during the pandemic, and you see a greater overheating on the autos and housing side, right? And you see this greater overheating for both asset classes. And then both of those things are very interest rate sensitive. And so when the interest rate shock occurred, affordability just got really strained there. And so now for a lot of Americans, when they go, whether they're living in a house and they'd like to buy something else, or they're a first-time buyer and they'd like to buy something, or they're a renter who's seen their rent go up a lot, housing affordability is a big pain point. And it's also true on the auto side as well, to a bit of a lesser degree. When somebody finally needs a car that hasn't bought one since, before rates went up, it's kind of staggering to some of them to see what those monthly payments are. And so Trump is trying to do things that at least ease the public's, at least get the public to think that he is working to address affordability. Yeah. Now, the thing me and is that whether you're Democrat or Republican, housing is a very tricky thing. Mm-hmm. It moves very slow. And a lot of the things that you could do that maybe help improve monthly payments in the short term are the things that would increase demand and could strain affordability, right? And so there's always that, that challenge there. And housing is going through some period of affordability improvement. You do have incomes rising 4% nationally. House prices, depending on what index you look at, they're kind of close to like around 1% up year over year. The first one to report full 2025, ICE, which that's not ICE immigration, that's Black Knight that got bought by Intercontinental Exchange. They are up 0.9, right? And so mortgage rates, the average 30-year fixed mortgage rate is down 75 basis points year over year. Income's up 4%, home prices up 1%. You see affordability improving a little bit, right? Mm-hmm. And it's a grind to do it. It's going to take a while to even get closer back to a historic average, let alone we're not on any trajectory to get back to 2019, 18, 17 levels of affordability. But you are seeing an improvement. Mm-hmm. But that pace, that's not a pace that the public enjoys. That's not a pace that, voters are going to, say, okay, yeah, that makes sense. I'm down with that. So they're going to want these headlines. And so on the institutional front, Trump has proposed taking steps to ban large institutional buyers from buying single-family homes, mm-hmm. or buying more single-family homes. And I didn't catch that more until a couple hours after it was first announced. Everything was moving fast. But if you go back and read Trump's...
Yeah, it was more, yes.
More. That word more, to me, signifies that it's less likely that he's trying to force them to sell off their portfolios.
Yeah,
I might be reading the lines too much, but that's my first.
No, I think that's an important word, because I caught the same thing. Because when I looked at this, regardless of whether or not it's legal or any of those things, it's headline grabbing, midterm elections. The thing I came back to was, okay, is it stop buying or is it forced selling? Because those could have dramatic differences in the market, especially in submarkets. As you've correctly pointed out a lot in the last 24 hours, Atlanta is like the epicenter for this, right? If you look at the rental stock of single family homes in Atlanta, they own, institutional owners have 25%. That is a lot. If you look at the entire stock of single family homes, it's 4%. I would argue that is a lot. So this question about whether it's buying more or becoming a forced seller is important, certainly in locations like Atlanta, Jacksonville, Charlotte, Raleigh, Tampa, right? I think those are the top 5 markets. What do you think?
I think you're spot on. And let me share some data here. Can you see my screen?
Yep, I just brought it up.
So before I share some of the data, I think it's good to point out the things that we don't know as of right now. We don't know if this is just kind of midterm year politics, or if it's a significant policy proposal they're actually going to get enacted, right? Would this ban be challenged in court? We don't know.
Yes, yes, be challenged in court. Let's just be clear.
A large institutional investor, like, what is the cutoff? Is it amount of dollars they own in homes? Is it the number of single family homes? Would it be targeted only at scatter site acquisitions, or also build to rent development?
True. That's a great caveat. That one. That's an important thing. Because again, as somebody who played in this market when they came in 2010, 11, it was scatter, right? They were buying the entire book of all the foreclosures, which changed the game immediately and frankly stopped the housing crash. But now they've realized that buying old homes scattered is not very efficient and frankly loses money. So now, to your point, which you've reported for years, they're just doing build for rent. We're going to go buy a big plot of land and we're going to pay Lennar or some other builder to build me 100 homes. And they're just buying them all. So I think that's a great catch. I had not thought of that.
And I think the public is way more uneasy with the scatter site going into the neighborhoods. That makes them more uncomfortable.
Correct.
Now, build to rent, you do see pushback for it, but I think at least people are like, well, the institutions are adding supply to the market. And I think that, that's probably where there's a bit less political pushback. And then the other thing that we can't answer today is, would the ban require institutional investors to sell off their current portfolios?
That would be a wrinkle.
The word more makes me think that that's not the case. But so Trump's said he wants to do this, and he's calling on Congress to move forward with it. Bernie Moreno in Ohio, where I live, said he'll introduce legislation in the Senate to move it forward. And on the other side of the aisle, there is support for this. Back in February of 2025, there was the Humans Over Private Equity for Home Ownership Act, introduced by a Democratic senator, and he had 2, 3, 4, 5 other senators co-sponsor it. So where it goes from here, we'll see. The big thing is, whatever effects would come out of it, it varies sharply by region. A lot of people out in the country live in areas where the large investors play very little in their buy boxes. But you have areas, like you said, in Atlanta and Phoenix, Dallas, Austin, Tampa, Jacksonville, Orlando, somewhat in Nashville and Columbus, where they do play a lot more. And the reason that a lot of the institutional investors are in places like Vegas, Atlanta, Phoenix is that, like you had pointed out, in 2011, when they came into the market, they were going after a lot of the places that were down the most, right?
Correct.
That's what pulled them into a lot of Florida, into Phoenix, into Las Vegas. And then the other thing is, Georgia has these things that the industry ended up calling Super Tuesdays, where they do an auction all on Tuesday, right, on a certain day of the month. And so it was easy for these institutional investors to fly down to Georgia for that one Tuesday. And so that's what started a lot of that ecosystem in Atlanta. And then, as you move forward, once they were established, it was better because of scale to go to the places that they already had maintenance teams, to go to the places they already had professionals, where they already had connections with the agents and brokers. And then as more institutional capital came into the market, they were chasing population growth, right? That's a lot of what they're chasing. They see that as long-term upward momentum for rents and an increase in the rental stock. And so that's where they went. And as build to rent really started to get going, that you saw them still chase a lot of the Sunbelt markets. So if anything were to happen, it would affect more of those markets. Now, if there was a forced institutional sell-off, in my opinion, it could potentially put additional downward pressure on certain neighborhoods in certain areas of the Sun Belt that are already experiencing corrections. So if you're an area that has a lot of institutional investors in your neighborhood, prices are already falling, meaning there's enough downward pressure to push prices down, and then there was a forced sell-off, that would be an opportunity for buyers, right? An opportunity for other investors, right? To potentially get good deals from those institutions. But again, as Trump said, to ban more, stop them from buying more, that word more makes you think and implies that it's not the sell-off. So I think that scenario I mentioned above, less likely.
Agreed.
With institutional buying, we're already well below the boom levels. So there's less demand actually left to squeeze out there. They've already pulled way back. This chart here shows investors that own at least 100 homes. But if you segment off just the investors who own 1,000 or more, the decline here is actually even bigger. They went from 2.2% to now they're only around 0.3. They pulled back.
Oh, wow.
And so this chart here, you can see that the bottom of the market, you see that swing up for institutional or for the bigger investors in the market. It then plateaus at a level that is below pre-GFC levels. You can't. This chart doesn't go back that far, but this is above pre-GFC levels. And then the pandemic housing boom occurs. Rents are ripping. Home prices are ripping. Abundant liquidity in capital markets. Super low rates. Very enticing period to allocate to SFR. You see a big boom. Rates spike. Capital markets pull way back. There's less of that demand there. If you asked me to give my biggest criticism of institutional SFR, it would be that in 2010, 2011, when the institutions got into the market, they were actually encouraged by the federal government to do it.
I remember.
According to Amherst CEO Sean Dobson, he told me a couple months ago when I was talking to him that Ben Bernanke and Yellen, they wanted them into the market. And at one point, they actually had a deal, Amherst, to buy 50,000 homes directly from the GSEs. It didn't end up going through, but Amherst did get into the scatter site buying. But what Bernanke and Yellen told him is that they viewed the institutions as a shock absorber to the market.
Exactly what happened. Yes.
In a way, they were during GFC, right? They helped to buy that bottom of the market, especially, where you are out in Las Vegas, famously, right?
Yeah.
Phoenix famously helped to put in that bottom, and investors kind of shoved up prices pretty quickly, helped in 2013, 14. And I think that was probably good for the economy, right? We were in
no question.
Needed a little bit of spark, right? Because people were just scared. The psychology of it was...
Dude, lending stopped, Lance. I mean, lending stopped. I was the enemy. Yes.
So that is true. But what ended up happening is that we saw a little bit of the opposite after GFC. When 10 years later, the pandemic housing boom started, they actually helped to accelerate the acceleration, right? So
Yes,
they were
they
kind of thought of as a shock absorber to the bottom. But it turns out they're both a shock absorber for a crash and also an accelerant for a boom.
Yeah, I think that's fair.
Because they see it as a big buying opportunity, right? And so more of that capital flows in. And so I think that it's not that they're wrong that they aren't a shock absorber. I think that they are, right? And some of these markets today, there's potentially only so far they could fall because capital would come in, right? You're not necessarily there at a place like Austin, but you could see it at a certain level that capital would come in, right? But I think they play on the both. And that view, is kind of hard for Bernanke and Yellen to potentially see back then, but it's definitely more nuanced than their view at the moment back in 2010. But they were also dealing with a crisis, and they just needed spark for housing at the moment, back then. Now, if we were to see a full-blown institutional ban, including a build-to-rent ban, in terms of institutional capital flowing into build to rent. That could negatively impact U.S. home building, in my view, in like 27, 28, 29. I think after that, the market would probably stabilize and find a replacement for that demand. But given that build to rent is now around 7-8% of starts, and a lot of the institutional capital that is in the market today is flowing into build to rent. You look here, this is AMH. They're one of the largest institutional owners of homes in the US. They have 60,000 single family rentals. This dark red here, that's scatter site, right?
Correct.
And there was a big boom up again in the pandemic housing boom, but then it fizzled out. Some of these larger institutions have not bought a single home off the MLS in a few years, which is kind of wild. Now, this light red, that's build to rent. They've still continued to be building homes. Now, this spike here, that's just them acquiring a bulk portfolio from another institution, but you can see that they're primarily doing build to rent. And so AMH, as of today, they are now the nation's 37th largest home builder.
Wow.
And 96% of all the homes they acquired in the first 3 quarters of 25 came via its in-house home building unit. And they actually built some more homes that were sold off to other institutions as well. And so I think that that is kind of a, something that Bill Pulte and Donald Trump, they got to consider, which is, if you push out this capital and you also push them out of build to rent, where does that other capital come from, right? And then the fifth thing of another consideration is that most of these institutionally owned homes are occupied, right? So if you did force them to sell, that tenant's got to go somewhere, right?
Yep.
So, if you evict them or wherever, they got to go find somewhere else to live. Now, one argument could be, well, they could just buy the home.
Yeah.
According to Amherst's own analysis, now they are an institution, so, keep that in mind. But their own analysis is that 85% of their current tenants would not qualify to buy the homes they're currently renting from Amherst, given today's prices and today's.
I would take the over. As somebody who owns a bunch of rental properties, I would assume it's well over 90% couldn't qualify today. But 85 is conservative.
Yeah, and that's the thing, is that even in normal times, many single family renters could, whether they're renting from an institution or mom and pop, they couldn't afford to buy the home they're living in. Let alone today, where you're at this point in the cycle where there is this huge gap between the monthly mortgage payments to buy today's homes at today's prices and rates versus what those homes would rent for. That gap there is huge right now. No. And some people are choosing to just rent at the moment, given where the math is.
Yeah. It's really interesting. I think this is a very important topic. There's lots of details here, right? We've gotten one post on it. You can split words, look for keywords like more. But at the end of the day, I think you hit it up first. President Trump is interested in winning the midterm elections. He was schooled, or the entire Republican Party was schooled in the last election by Mamdani. Mamdani ran a great campaign. His campaign was amazing, and he won. And it was all on affordability and giving away free stuff. And I think Trump realizes that Trump has to look like he's sticking up for the little guy. And this is just one way to go, we're going to go get them. We're going to get institutional buyers out and we're going to protect the homeowner. But as we've gone through here, it won't mean a hill of beans, but it might get him the election, which is, again, what he wants. He wants to win the midterm election.
And I think you're going to see a lot and which is
yes, you are. Yes,
you're going to see housing populism, right? Both sides, right?
Of course.
And now a few more charts. I do have a few more bonus charts I threw in here. 77%, according to John Burns, of single-family rentals are by landlords with 1 to 9 properties. This analysis will vary a little bit depending if you look at Batch Data's numbers or John Burns, but John Burns puts it at about 77%, 3 and 4 rentals are owned by the smallest mom and pops. And then 16% by 10 to 99 properties, around 4% are in the 100 to 1,000 properties. And then 3.4% of single family rentals are the institution, the biggest players, 1,000 or more properties. Lately, more institutional landlords are net selling than net buying.
Exactly.
and so that demand has really been pulled way back. And a lot of that is math, right? Where, for the institutional players, they look at SFR relative to yields across the entire global economy.
Yep.
And so, the past few years, they've been a little bit less enticing. The other thing is, and I was talking to some institutional groups in New York, is that they had increased their allocation to real estate and single family during the low rate period. And just the allocation percentage is a tiny bit higher than they would like it to be. And so even though some of them are starting to get a little bit more enticed by the yields, they're still held back because they have certain percentage thresholds.
Allocations. Yep.
Yes.
Makes total sense.
And then the major institutional portfolios, you will hear a lot of things on Twitter and social media about banning BlackRock from owning homes. They mix it up with Blackstone.
I think that's hilarious. It's not BlackRock, people. It's Blackstone.
Now, Blackstone did used to own the company that ended up becoming BlackRock. They spun them off in '94. But I don't give people credit for that mix-up because Blackstone back then was very tiny. Nobody even knew who it was on a national basis.
You're being too kind. These are just idiots.
So if you want to know the history of Blackstone, your audience, real quick summary to that. So back in the late 80s into the early 90s, the CEO of Blackstone saw a huge buying opportunity in the bust of the savings and loan crisis. Now where he saw the best deals was in multifamily, is where he was trying to get his investors to go to. And he tried to get capital to allocate to it. And everywhere he went, people were like, nope, we don't want to do it. We were actually we were losing money in our real estate holdings because of savings and loan. We're not going to put more money into it. And the few investors he did get together to buy some of this real estate ended up having around I think it was 50 or 60% annualized gains, just insane numbers.
There you go.
It's on the dollar.
Yeah.
And he said that if that ever had happened again, he was never going to miss a great buying opportunity like that. And so if you move forward to 2008, 2009, he was already getting interested in single family rentals, but as prices continued to fall, he was getting the capital there. And then as the government was starting to encourage it, by 2009, 10, 11, then they're moving in, and their firm ended up being Invitation Homes is where they held the single family rentals. They started to sell off, I think, around 2016, and were fully out of Invitation Homes by 2019. Blackstone was. And then in 2021, during the pandemic housing boom, they bought Home Partners of America. And then they bought Tricon early 2025. And so they're back in the single family rental game, and they have around 57,000 rentals. Home Partners of America, they were like the rent to own model. They've since folded, and their homes have went into Tricon. So that's like the history lesson of Blackstone.
Very good. Very good. Well, Lance, you are amazing, folks. If you want to get his articles, his free or paid, go to ResiClubAnalytics.com. Sign up for his newsletter. You won't regret it. He is the data source for everything real estate. Lance, thank you so much. Have a great week.
Housing. Thank you for having me.